Good morning. How you doing? Really good to see you. Thank you for coming to today's Forex trading strategy session. My name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. These strategy sessions we cover Forex, energies, metals, indices, binary options strategies, and both for scalping and for hedging. A little of everything to make even, I don't know, the grumpiest trader a happy camper. It's 7:30-ish in the morning. It's the 9th of April, Thursday, 7:30 a.m. New York time, London lunch. This is our opportunity once a day to get together as a community of foreign exchange traders to collaborate as contemporaries and comrades. Hey, if you're watching this recording on YouTube, you're about to get 1 hour of technical analysis and trading ideas. Spend 1 second, at least 1 second, pay it back, click a like, but more importantly, document what you took away from the trading session. Document what you liked, what you learned, what you thought was of value. And again, you're taking 1 hour worth of value. We're asking for 10 seconds, 25 seconds of your time to pay it back. I don't think that's too much to ask for. All right, so let's get going. We've got a lot to do today. Let's just do a whole bunch of technical analysis, follow up with our trades from yesterday and earlier in the week, set up some new trades. You let me know what's on your mind, whether you want to scalp, spot, swing, or trade. We can get her all done, but we only got 59 minutes more, so let's get going. Thank you for Traders Way. Love doing these sessions with you. Hey, remember, trading and investing is risky, not appropriate for everyone. You add leverage, and it's even more inappropriate for some. Hey, if you're a hero yesterday or a zero yesterday, remind yourself that today is a new day. Your past performance does not predict future results. So always stay small, stay humble, focus on the long term. Money you cannot afford to lose. Save it for the market. All right, my friends, so this is one of the trades we left off yesterday. I haven't even touched the charts. It's just there from yesterday. So we had this big old discussion. I don't know, let me check my notes and try to figure out what the trade plan was. Does anyone remember what it was? Oh, sell it up there near resistance. You guys remember doing this? Yeah. Hey, good job, Ken. Ken took detailed notes, as he always does. Yeah. Interesting, right? So one of the messages we cover over and over and over again is have a bias, and even when you're wrong, like let's say I'm a bear on oil, so I wanted to sell. But we also talked about, someone else wanted to long it here, and I said, well, if you were going to long it, you would long it down in here, and it looked like it was possibly ready for that. So if that's your plan, do it. Right? And someone else said, well, when you get conflicting indicators and stuff. It's only conflicting because you haven't made a decision. Because at the end of the day, if you're a bull and you're at support, you're supposed to be buying. I mean, what else are you doing, right? So you're only conflicted if you haven't made the decision. So in any case, that was sort of my risk. But my risk is someone else's opportunity. Well, in this case, the longer-term fundamentals did kick in. But you know what? Hey, I was wrong all through this up move. I mean, I just didn't get it. Didn't see it coming. This move from 46 to 54. I mean, didn't see it coming. But at least that's that here, right? That's pretty clear. Now, if you were a bull on oil, yeah, it's reasonable to connect some of these things up in here. I'm sort of looking at this was resistance, this was support, this is resistance, stuff going on here. It's doable, right? If you're a bull, oscillator's fine. You probably didn't like the lower low. Okay, good. Now, why do I point out the old the old support zone. Why do I, if yesterday a bull had the opportunity sort of in here, why would I mark it now? Why would I care about it now? Why would I just plot that? Dun, 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 dun. Yeah, it's our new resistance if you were a bear. What would you want to do? Drop it like it's hot. Drop it like it's hot. Oh, a 382 Fibonacci retracement. What do you think? Oscillator's okay, right? It doesn't say, whoa, 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 don't even do it, dude. No, it's I'm like, look, if you want it, right? Time to wake up and smell the concrete. So, yeah. So, you know, what we're thinking here is what's the sweet spot? Sweet spot somewhere between the 382 and 618 Fibonacci retracement. Good enough for the girls I go with. Actually, nothing's good enough for my wife. But I think you understand, right? Igor is Igor. I like your code for confirmation. The Enigma. So, anyways, yeah. What I don't know. What do you think? You want to? You're going to take it short? The old lower low, lower high routine? Yeah, Ken's thinking about it. Well, that's cool because 24 hours ago we sold it here anyways. Didn't go up as high. Actually, you know what? I did say 50, right? Can anyone confirm that? We were at like 52.70, and I'm like, we're only 30 cents away. Or no, whatever. 52.70. I'm like, we're only 30 cents away, but it's all the difference in the world, right? Yeah, and Ken sold it at 53. But that was the plan, right? Wasn't it? Do you remember since you took it? I didn't throw a binary on it or anything. We were just, yeah, but it was, right? Sell at 53. Yeah. All right, so anyway, so it's up to 50 and a half. That's worth money though, right? $2.50 on oil is actually pretty gosh darn good if you're trading futures. Yeah, well, so Mike, it comes down to where is the resistance, right? And since we're above the moving averages, you can't use moving averages for resistance. So what's the most important piece of resistance we could have, and that would be a psych level. Right. The next one would be a double top. Right. Yeah, either previous area, but you know, it's just, you know, never forget the psych levels. It's just like if you're at 52.70 and you're thinking like, I'm ready to short, I can't quite short here, where am I going to short? Psych level. If you're 52.70, 53. If that don't work, 53.50 or 54, right? That kind of thing. And you need to start plotting your areas and your zones. Would you, Gregor's bought it? You bought it 16 hours ago down in here? Yeah, that's cool. Right? Just above 50? Yeah. Yeah, I think you know, you can see, I mean, you're a robot, right? Look, you don't need to be a rocket surgeon to figure out, you know, this gray zone is a buy zone, right? So. Okay, now, yeah, Goldilocks. Let's just finish with the commodities. Remember, commodity currencies were quite strong yesterday. So, yeah, I prefer gold coming down, obviously. I want the U.S. dollar to be strong, so therefore gold should come down. You know, what are the key things going on here? You know, I think it's important that we've breached this confluence here. Like, I think this area was important. You know, no matter how you draw it. Okay, so on and so forth. You can draw that, but then you got to do this one, right? But what else is important here? Let me tell you, it's not on this time frame. What else is important here? While you're thinking about it, let me show you. Do you see it now? Mike makes a comment about psych levels every 25 pips. Mike, my favorites are psych levels and midpoint psych levels, so 0, 0, and 5, 0. Now, these other ones that you're talking about every 25 pips, what's actually going on there is it has to do with stop placements. So you have 20s and 80s around the psych levels. Now, it's a complicated question, but so I think at a basic level, someone could interpret that as every 25 pips, but really it has to do with, imagine how many people are either, they're adding limit orders for taking profit. If price is below, all right, let me back out here. I wasn't going to cover, but let me back out. All right, you're long a trade, and you're getting closer and closer and closer to a psychological level. Whatever it is, 53.00, something like that. Whatever you're trading, it doesn't matter. Okay, you bought at 42.10, or 52.10, and you're up and up and up and up and up, and you're getting closer and closer to 53.00. Would it be reasonable to think that some traders would have their limit order to get out of the trade for profit somewhere around 00, the 53.0000 mark? I mean, everyone can see it coming, right? Do you think there's a reasonable amount of traders? Come on, guys, I'm talking to everybody too. Right? Like, where would you think? This is important. You have to anticipate what the other trader on the other side of your trade is going to do before they even do it, right? So you're in the trade, and you're like, we're coming up to 53. They're going to start taking profit, right? Now, you tell me now, do you think they're going to get out before the psych level or after the psych level's been breached? What do you think they're going to do before they've even done it? What do you think they're going to do? Is it 1 pip? Is it 10 pips? Okay, and then what about other traders that want to get in? Are they going to get in just below the psych level to go long, or are they going to get in after the psych level? Okay, where would they put their stops? Well, you say 50 pips. That's your training. I read statistics somewhere that the vast majority of stops are all within 30 pips of price. So it's one of these things. Let's say you long at 53.10. Your stop's at 52.80. And of course, if you reverse that, if you shorted, let's say you were a bear and you shorted right where everyone was taking profit, that's a good place to short, right? Okay, let's go back to the first scenario. You bought at 52.10. Take profit somewhere like 52.95. Five pips before the psych level, right? Is that what we agreed to? Okay, Ken's like, yeah. Okay, now let's reverse it. You're not in the trade, but you're watching it go up to the psych level, and you say to yourself, traders are going to take profit at 53, at that huge psych level. Could you possibly short at 52.95? 52.90? Because, with some, you got to cover your spread and stuff. What do you think? Is that a reasonable opportunity to consider if you're not in the trade, that you're gonna hunt stop Those stops are going to be there, those limit orders, right? You can hunt those down because you're a shark. You're smart money. You think you're going to get out. You haven't even got there yet, and you already know what they're going to do. So you're going to set up an ambush, right? Yeah, and you're going to scalp off the cycle level and hit those stop losses. And what happens if you hit those stop losses? You get a cascading effect where all of a sudden all these orders are coming out of the market. They're long, so the broker has to offset those longs with short positions. So the price comes down, you get a red candle, and you're shorting, triggering more stops, and then freaking other people out, and they're manually getting another position, and it comes all the way down. But when you shorted, let's say by the time you cover your spread and stuff, let's say you're short at this, this 52.90. Where's your stop now as a bear? $53.20, right? That's why it's 80 and 20. Because it has to do with, because you're not going to pull the trigger at exactly the right moment. You're going to wait for a red candle. So by the time you actually were short, you're short at 52.90. Vast majority, 80% of trade of stops are going to be 30 pips away. That puts you at, right, 53.20. And so that's why I say there's an 80-20 rule. There's lots of things going on around psych levels, and if you understand what's going on, in particular, some psychological levels are more important than others for various reasons, limited different reasons, but some are more important than others depending on the scenario. But if you understand all the different players, right, the ones that are long, have been long for a day, they're getting ready to panic, and then some people are going to jump in the market as short-term scalpers for the next half an hour, and they're going to short against them, and then others are going to wait for the long, and all of a sudden, all these orders are going in. You can just imagine if you're the broker now, all these orders are going in, boom, 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 and all these stops, and if it breaches the psychological level, all of a sudden people are long and dropping stops on the other side, and all this stuff's going on. So if you don't really get it, it just kind of looks magical, like every 25 pips is important. Well, not quite. You just have to understand what's going on. You have to understand the mechanics of the orders. The important thing is the psych level, and then where you are and what strategy you're applying, and then the midpoint psych level. Now, when you talk about the midpoint psych level, like 53.50, it's important, but not nearly as important, because you're not going to get all these different clusters of stops and limits all being thrown down at the same time, above or below price. Okay, Mike? I digress. Let's go back to gold. Yeah, what I see here is we came up, made a 50% retracement. Okay? And I think that's significant. And then after that, we came through and made a low lower than the previous, right? As you know, this second gray zone, the lower gray zone, was a buy zone. So what in the world are we doing way down here at the weekly central pivot point if we're, this is an uptrend? And I'm thinking it's not an uptrend. But we've already talked about that. I think it's a downtrend, but prices move up. And I say, good, it just allows me to sell it. Okay? And look at the price of gold. 1,200,000,000,000,000,000,000,000,000,000,000. Hoo-ha! Could be important, right? So what are you going to try today, maybe? Call me, maybe. Anything like that, perhaps? It'd be interesting, right? Okay, let's take a look at the stock market. Yeah, I think we have a trade plan in place. Yeah, we did this a long time ago, actually, didn't we? Was this from non-farm payrolls in here? Anyways, yeah, right now, apparently my poorly drawn arrow, which I think we did on a different chart here, is propping up the entire S&P 500. Oh, good. Well, we all have a job to do. Apparently, that's mine. So the news to use here is we got a higher floor, right? A higher floor. We've gone from the lobby up to the mezzanine level, right? Cool. Cool. Right on. Let's see if we can get to the next level. This one's tricky, right? So, wouldn't it be nice to get above there? Yeah. The weekly target is 2,100. It'd be great to get that and see, because, you know, that A, it's a predict high, and then B, it's a higher high. Yeah, we're in a wedge, I think. Yeah. So it'd be cool to get above that. You know, honestly, it'd be better to get a weekly R2 up, top it off of this. And then I think what we do is probably come all the way back down here and then all the way back up. So I'll just draw it here. Or you know what, maybe I can draw it like, okay, so anyways, let's move on.com. Piggy, 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 can't you see? Sometimes your pips just hypnotize me. So pound yen, huh? What's the bigger trend? Still at support. Or as the French like to say, consolidation. That's French for support. Okay, you can grab that. Notice how we respected the pivot point so beautifully. Cool, man. But that's not necessarily a trading pattern I like. Right? So we'll just leave that there. But, you know, what I like to see, let me back out. So I don't really see an amazing trade opportunity. I mean, you could buy it here off of support. You got the oscillator and stuff, 70, 78. Yeah, I mean, it can. I consider this minor resistance, right? So, yeah, so I'll walk. But the interesting thing here is the red zone is the identified top from Monday morning, and we topped, it dropped. All right, cool. Okay, it's made a lower low. Am I going to buy it? Not today. Let's take a look at euro. What do you think? Back to support, huh? Want to trade non-farm payrolls with me? FX Street. Anybody? There's up to like 700 people registered for that. Yeah. Dollar got really weak, right? Euro dollar went up and up and up and up. What was my initial response? Euro dollar went up and up and up. Did I say, "Oh man, let's buy it. Let's buy it. Let's go 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 go." Woo! I'm like, good. Well, let it go up. The higher the better. And then I'd like to sell it. Yeah, but you know that's what That's what a bias is all about. That you just don't freak out. You're like, oh, all right, well, it might take you out of your trade for that day, and you're just like, all right, well, let's wait. I probably won't get another trade till Monday or Tuesday, and that's that. So, anyways, let's zoom in a little bit here. What has happened since the NFP? Right? That was probably it. Went up to 110, triple topped, lower low, lower high, lower low, lower high, lower low, fib of the drop, and here we are. Nice, huh? It's dropped 300 pips. Huh. What'd you know about that? But all it did is, I mean, it's almost silly, isn't it? Goes up, touches the psych level. Where did people get out, right? It's like, really? I think and I say this is like a human nature thing, we tend to make things more complicated than they really are. Right? This thing went all the way back to the psych level, and then the market sold it again. Cool. Beautiful price action, though, right? You can see it, right? Down, 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 up, up, sell. Down, 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 up, sell. Down, 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 up, up. But no higher high. Sell. Down, 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 up, sell. Right? And then blah, 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 whatever. Now we're consolidating because we're clearly at support. I mean, yeah, right? Yeah, 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 right? Cool. So am I going to sell here? No. Am I going to buy here? No. All right. Now, the interesting one here is USD yen. All right. We're consolidating once again. Pretty close to the pivots, which is nice. It means it's logical, right? 1 hour chart. What do you think this will be doing 8 hours from now, this oscillator? What do you think it'll be doing in 8 hours? All right. So what do you want to do now? Well, I think we should adjust the pivots, or I mean the fibs. Let me get rid of this. That's from an old trade plan. I just love your Jersey ways. Okay. So what do you want to do? All right, where? Beastus is buy. Cool. Where? One thing that grabs my eye is the 618 weekly central. So that's still 50 pips below us. The next closest would be the psych level, right? Midpoint psych 50, which is still pretty far down here. So the more aggressive one would be a bounce here, which would then leave us to the top. What? Currency! So Mike says 70. 70? Yeah, I guess that's where we are. See, that's the point. 70, based on our discussion just a few minutes ago, 70 is a worthless number. Right? Right, think about it. Who's going to enter there? Forget about, this other stuff going on, but just 70 as a number. 50, I get. 00, I get. Just below the 00, or a breakout above 00, I can see how that will put you in. And depending on whether you're shorted before the psych level or long after the psych level, the stops are going to be around 80 and 20. I get that. Midpoint psych level, that's 50, but there is no 70, right? Right? There is no 70. So it feels like it's in the middle of the road. What we do have is that's a 50% Fibonacci retracement, and it's also a weekly pivot point. All right, so I guess we make an exception, but it's not an exciting trade. So I kind of think it's going to do the second one and kind of kick off here. Now, if it goes lower than that, it once again makes me very unexcited. Because if it's so bullish, why do we have to make a 618 Fibonacci retracement? And I certainly don't want to go any lower than that. I don't want to breach below the weekly central. Okay? So I kind of think it's going to go that far, but now we're kind of like at the 70, like 35. Is that important psychologically? No. Do you think there's a cluster of orders there? No. And so that's why I'm like, ho-hum. But, whatever. Maybe it'll look good tomorrow, but we're already long, right? So, yeah, the oscillator's thinking about maybe. So, the 382 50% area. See, I'd almost want 80 instead of 70, Let me kind of look at it this way. I'd rather just have it bounce off the 382. Call it an 80, and if it bounces at 80, it's going to go to 20. Because that's where the other orders are going to be, right? What happens if you break through 20? Well, let's think about this logically. If you bought at 80, and what do you think? Where do you think the orders are going to be? Where's the next cluster of orders going to be if you buy it at 80? Well, we talked about the scenario of when you get to like 95, there's going to be bears, right? So around 90 to 95, there's going to be bears. And where are their stops? Right around 20. Okay. Let's say you buy at 80 and it goes up and there's some challenge there. It's difficult to get through the psych level. But all of a sudden, boom, it pops up and it gets through. 5% of the bears panic and take small losses, whatever. And that pushes you up a little farther. Now you're at, at 10. Some more, but now you've gathered a few more bulls, so some scalpers that went long on the break, they're long, and that moves it up to 20, and you hit a bunch of stops. Some boom, 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 boom. All the bears in the market are all getting out because their stops are being hit, which means their brokers are putting long positions to offset their short positions. The market goes extremely net bullish on the short term, and it goes up to 50. Now you have 70 pips profit. What do? You start looking for reasons to take your profit and get out. Hits 50, hesitates, comes back down to 20, and then you decide to get back in, goes back to 50, goes all the way up to 80, and then all of a sudden there's lots of limit orders and bears waiting to go against you at the next psych level. So 20 is not a psych level, it's just where there are orders. Well, you got to listen to the language, Mike. That's where the stops are for those that shorted at 95 or 90. That's where their stops are. So it's not a psych level, it's just 30 pips away. And 80% of stops are 30 pips away. So it's just where the stops are. But it begs the question, well, what happens when you get to 20? And there's a cluster of stop orders around that 20 area. Well, if you hit them, they're going to convert to longs. All right? They're buy orders to offset a short position. So there's a lot of buy orders sitting around that 20 mark because a scalper doesn't want to risk more than 30 pips. So if you hit those, boom, 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 you're going to go up to the next level. The next level is 50, the psych level, the midpoint psych level. And then what happens to a lot of traders that have 50 pips profit? Let's just talk psychologically the other way. It's not price, it's dollars. Does it feel good when you get a trade to 50 pips? Especially if you do it in like in a half an hour, 45 minutes, and you're up 50 pips? What do many short-term traders like to do? Get to psychological levels like that, like 50 pips. That's a half of 100. Feel good or talk yourself into getting out? Lots of traders just get out. So you approach this midpoint psych level, because think about it. What happens? It gets to the midpoint psych level. Some of the traders start taking profit. It comes back, and it comes back from 50 back down to 20. Well, that's a significant pullback, right? So let's do it this way. You got in really good. You're long at 80. You're approaching 50. Now you have 70 pips profit. And all of a sudden, it goes from 50 to 40, from 40 to 30. You saw your 70 pip trade decline, right? Now you only got 50 pips. What do? You probably bail. You're like, you know what? This is good. Just give me my 50 pips. But that's why a really, really good trader doesn't trade more. They just have more discipline to carry out what their expectations for markets are. Like, for example, they got in at 80. It was a great trade. They were right. They broke through all this, resistance level, knocked out all the bears, all the way to 50, and they say to themselves, I'm just going to take my 70. They're done for the day. Whatever. They decided not to hang on to it. They're just like, give me the 70 pips. Well, they didn't do anything different except not wait for the 20%, the 20 pip retracement and then bail. They're just like, man, it's gonna pull back here, and I just don't want to hang on to it. I just don't want to suffer. I'm not that confident. And they take the 50 pips, right? right? So they didn't do anything different, but you know, if you look at it like over and over and over and over again over the course of a year, those 20 pips that they didn't go up based on weight, freak out on pullback, it adds up statistically, right? But sometimes they'll say, you know what, I do feel confident in this trade. I have 70 pips. I'm going to lock in 15 or 20, and I'm just going to let it run, and I'll come back and revisit it in a day or two. And in those ones, it goes from 70 to 150 to 250 to 300 or whatever, right? What they didn't do is over-manage the trade, watch it go to 70, and then not have a decision already made, like, I don't feel confident, so I'm going to take my 70 pips. It's near the end of the day. We're near midpoint psych level. I'm just going to take the 20 pips because I believe it's going to pull back at least 20, but it could possibly reverse, so just give me my 70 pips. They didn't need the pullback and the emotion of the whole thing to make the decision. Or the opposite, they're like, I feel really good about this trade, and I think this is just the first 70 pips in a 300 pip sequence for whatever reason, pivot points, fibs, whatever. But they've made the decision, and they're like, oh, I'm going to lock a small profit and just go find another trade. And that's so, but their 70 pip trade probably did still come back down to 50 or 40, and then went back up to 100 but they've made the decision that they're going to let this one run. But they're not watching the pullback, and they're not freaking out. They're not saying, oh, it's 70, now it's only 60. Oh, no, and now it's 50. And making, like, emotional decisions. They're making logical decisions. So they're either taking the pips and run because they don't like the market conditions, but they made a decision, or they like the market conditions. Once again, they made the decision, move the stop, take a walk. And they're not doing, like, the entries the same, right? But that and the plan was the same. The difference between a half decent trader and a fantastic trader is usually their sort of their behavior, not technical analysis, not their fundamental analysis. In fact, you'll see that a mediocre trader will trade more than a fantastic trader. But the fantastic traders made decisions ahead of the time and carries that out logically. They're like, on this occasion, I'll take the 70 pips. And in a different occasion, they're like, it's worth way more than 70. I'm just going to jam my stop. I'll come back in 2 days. It'll be 300 pips. Done. Okay? But no extra work. And sweating bullets a little bit less too, right? She works wise for her money. She works wise for her money. Right? It's all about controlling your behavior because you can't control the market. So I think it works out. I wrote a magazine article about it many years ago, but I think it works out like what I was trying to say is, a really good trader, like a professional trader, probably makes 20% less trades, but makes 40% more money than a competent technical analyst, right? But how about this? Let's take it from a different point of view. There's a difference between an analyst and a trader. How many people would agree to that? There's a significant difference between an analyst and a trader. For example, an analyst at a bank makes $80,000 a year. A trader at a bank makes $8 million a year. Right? Why? Yeah. So, what's the difference between someone that really understands technical analysis and applies it to the charts versus a trader. Well, the trader makes these decisions ahead of time and can maybe is more aware to the market sentiment and conditions at the moment. No, not aggressive. No. So, for example, we were talking about it yesterday. I was reading an article by about Robbins, who wrote a book recently about money, and so he interviewed some of his hedge fund friends because he's been hired as a consultant for people like Tudor Jones and some other like very famous hedge fund and mutual fund traders that manage billions of dollars. He's like, they're the one common denominator amongst all these guys, even though they all do different things. They all make money, but they all do different things under the umbrella of traders. But the common denominator is they're obsessed about not losing money. They're not aggressive, Mike, and that's the whole thing. And in fact, when you think of a retail Forex trader, you think of you think of a guy that's scalping, making a bunch of trades every day. Go. Oh, throw that there. Make that trade. Move that thing. Oh, look at all the money I made today. Woo! And there's that persona of this guy that's just going in and scalping some money out of the market. Yeah. But when you meet hedge fund managers, they're mathematicians. They're bean counters, right? They're accountants and quants. They're math people, right? They're not, they're not poker players. They're not like the guys you see at the table, playing Hold'em. No, they're PhDs. They're very conservative. They don't put money down unless they're, absolutely sure they're going to make money. I think one of the examples in that article, and I don't think it was, maybe it was Paul Tudor Jones. It was like, I think he says something like, a regular person will invest $1 if they're pretty certain that they'll get like a 20 or 30% return, right? And he says, but the people he interviews, these professionals, they won't put down $1 unless they're certain they're going to make $3 or $4 or $5 back. Forget about the 30% return, because it pays for the losers. You have to pay for your losers, and you got to give yourself health insurance and all that kind of stuff, and you got to pay for the months that you're not profitable, and you actually won't get paid, but your expenses are fixed and all that kind of stuff. So no, they're not focused on the $5. They're focused on the average. So one thing I say every day, right? Stay small, stay humble, focus on the long term. Why did I say that? You'll know if you've read my that how much time do we have? We don't have much time, so I'll go short. I'll make it short. When I first started trading, I had my ups and downs for sure, and I got to a point where I had quit my job. I was a very happy venture capitalist that I had an office at the top of a skyscraper, 3 windows in my office overlooking San Francisco Bay. I actually could see the water and the Bay Bridge. It was just wonderful, right? And we had about 300 people in the company. It was just, and then I had quit to become a Forex trader. Okay, so here I am. I'm trading at home for a while, and everything's fine, except I start making mistakes that I hadn't made before over the couple of years that I'd been trading while I had my day job. And anyways, long story short, it just came from I didn't expect or anticipate trading by myself in the middle of the night, how that changes your behavior, and I started to make mistakes. because I was trading alone, middle of the night, and I just didn't have that in my risk analysis, right, before quitting my job. So anyway, so I felt really bad, let's put it that way. And so I'm in this abyss, like I just quit my job. It was a fantastic job, right, to be a currency trader, and I'm struggling through this, and I'm not making the pips anymore. And I was very methodical. I mean, we can go into all those stories later, but anyways, it was a dark time, right, where you're staring into the abyss, and you're wondering if you should keep fighting or just end the whole thing, right? And so one of the things I decided is I asked myself, well, what has brought me success in the past? Because I had been successful before. I had been up in the newspaper multiple times and in magazines multiple times, all before Forex. I'm famous for Forex now, but I was doing other stuff before Forex. So I'm like, well, what brought me to success before? And there was two things. One, I always had a business plan. Always I had a plan. Always. I'm like, well, I sit down now and I'm like, my plan is make as many pips as I can today. Well, nice, right? Not specific, measurable, attainable, realistic, and timely, right? And then the second one is I always surround myself with successful people. And here I am sitting all by myself, 2 o'clock in the morning in California, in the middle of winter, middle of the night, all by myself. I'm like, what did I get myself into? So long story short, the first thing I did is I held a business planning retreat with myself. I stopped trading completely for at least a week, and I sat down and I wrote out a whole business plan. I think it was a 3-year business plan. I covered everything. I'm a thorough person. Then the next thing I did is I realized every time you have a business plan, you have to have financials. I'm like, well, how am I going to do this? And what I did was I did a pro forma cash flow statement of all my trading results that would occur in the future. And I needed a magic number, like how many pips am I going to make per day? Well, so I went back and I analyzed my past performance. It doesn't predict future results, but I need an average, right? And I looked at all my trading, and I found out after several days writing spreadsheets and going through my trade history that when I locked in 15, if I can get my trade beyond 15 pips, I always made 30 to 50 pips. If I had 10 pips profit, it didn't mean I was going to be successful. That could also become a loser. So I can get lucky and have 10 pips, and then it could come back. But if I could get 15 pips or more, it would definitely go more on average. So anyways, I started focusing on this key level of 15 pips. And that became my minimal acceptable performance. And I took the 15 pips and I looked at the risk I was taking per trade for my account balance size. And I thought, if I averaged the 15 pips at my average risk tolerance per account size, and then I needed to pay myself, so I had to look at the percentages I would pay myself versus the other percent goes back into the trading account so the account could grow. So I did all of this, and I did this 3-year performa cash flow statement based on all of this data that I just shared with you. I mean, it took me, it was more than a week. It took me a couple of weeks to do all this, right? Because I really had to think about it and write it and do it all in Excel. Anyways, here's what I took away from it. Each and every single day didn't matter. Each single day just didn't matter on the long run. Because now I had a 3-year perspective of what my trading was going to do. Right? And if I had a bad day today or an amazing day today, statistically it won't matter in 3 years. Because I'm looking at the 3-year average. And suddenly I realized if I hit my minimal acceptable performance on average, right, that's my minimal acceptable performance. If I simply did that every day, I know what the input is, I know how the lot size, what that's going to be, and I know what my account size is going to be, because these are all variables you just calculate. And at the end, You know, let's say you pay yourself 25% and then 75% goes into your account, and you do that for a while until your account size grows. Then I would lower my risk per trade as the account size grew and became even more and more conservative. But I knew if I just did the minimal acceptable performance day after day after day, I knew what the result was going to be. And let me tell you, it was too much money. It was stupid. That's why I actually started lowering lot size as the account grew, because at the end of 3 years, it was fantastic money. I'm like, holy crap. But here's where we get, stay small, stay humble, focus on the long term. I realized that today didn't matter, and I did not need to gamble. I did not need to put in a big trade and make a lot of money and get as many pips as possible. And it was such a freedom, because I realized I just needed my minimal acceptable performance. My minimal now. I now focused on making my minimal acceptable performance, not thrusting this obscure goal of make as many pips as you possibly can. Because then you start making mistakes, then you start making big trades, because you need to make a lot of money today to cover your losses yesterday, right? And you start doing stupid things, and now you have one losing day followed by an even bigger losing day because you were gambling a little more and trying to make it back, and you're so stuck in the moment. And it was a relief. I felt so relieved after going through this dark period that now I simply, every single day, had a very focused goal. Achieve my minimal acceptable performance. I didn't need to make big trades. I didn't need to make a lot of trades. If I just achieved my minimal acceptable performance over and over and over again, a little bit every day, compound interest takes care of the rest. Compound interest takes care of the rest. I knew what the output was going to be. You want to make a lot of money? Well, you just don't have to make a lot of money today. Just don't lose a lot of money today. And you don't need to make a big bet today. Just achieve the minimal acceptable performance. Oh, I can do that. You see how all of a sudden my entire mindset changed? I can do that. And now I had the business plan. I had 3 years of pro forma cash flow statements, day by day, week by week. I knew where I'd be in 27 weeks from now. I knew where I was going to be 75 weeks from now. And it was such a relief. And I could stay small. I could stay humble. Because I did have a focus on the long term. And it was an unbelievable relief, like a burden had been removed, like Atlas carrying that stone on his shoulders. Suddenly I put it down and I realized, I can do this, man. I can do this. It's beautiful, beautiful, wonderful, thrilling even to know that you can do it. Just, you know it. You absolutely know it. Now you just have to do it. And the rest, it's all in the plan. It all takes care of itself. Got to go. Peace on earth. Pips be with you. May your profits be above average. Remember, stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Thank you for being a client of tradersway.com. Tomorrow we're going to be at fxstreet.com. So please go there and register there. Hasta la vista, Ace. Yeah, and like I said, if you're watching the recording of this session, please leave a comment. And if you don't have 30 seconds because you're so busy that you could watch a video for an hour, but you don't have 30 seconds to leave a comment, then spend a half a second and click the like. Huh? Give it a thumbs up. See you tomorrow. Bye-bye.